Thank you, Rob, and thanks for hosting Mass Land Trust Coalition. This is a workshop that I consider to be essential for anybody who is doing deals for land conservation in Massachusetts. And whether you're a board member or a staff person, having a working knowledge of some of these concepts, I think uh, is really should be part of your portfolio of skills and talents. Nobody else is going to be able to guide landowners through these concepts, not their accountants, not their attorneys, in a way that the land trust community can, because this is our bread and butter. This is our niche. This is what we do for a living. And so we're not here to practice law, practice accountancy. We're here to expose you to concepts. Each one of these areas of tax benefits, tax law, we could spend a whole day on, and believe me, there are professional groups that do that. But we want to expose you to them and get you to understand how they can interact with each other, to encourage more land conservation, more landowners to want to work with us, because we are the fount of information on this particular topic. Next. I'm Mark Robinson. I'm the executive director of the Compact of Cape Cod Conservation Trusts, and that's a regional nonprofit representing land trusts throughout and watershed associations throughout southeastern Mass. I've been doing this work since 1986. I have no credentials in the things that we're going to be talking about, other than as a so-called seasoned practitioner working with hundreds of landowners throughout our region and over many years. Haven't gone to jail, haven't been sued, so I think I can safely say that if we put the right caveats on this information, it will be useful to people and not in any way giving you a problem in the future. Rob, would you like to introduce yourself?
Sure. Thank you, Mark. I'm Rob Warren, currently working as a land conservation consultant, but over the last 35 years, I've worked with the Mass Department of Fish and Game and the Nature Conservancy, where there was a big focus on learning this body of knowledge, and then with the trustees of reservations more recently. So I think with that, let's go ahead and jump in. Mark, you want to get us
Yeah.
rolling?
So just to start off, and believe me, we're going to rush through a lot of this because it's dense. We don't want to spend too much time on any one subject, but we want to have some time for questions. We hope not to go beyond an hour, and we have a little interactive exercise at the end if we have time. So essentially, working with landowners on tax advantages, everybody's going to have different set of financial circumstances. There are different decision makers within a family. It's ideal if you can just deal with one person making decisions. That often is not the case. Sometimes it's generations that you have to deal with, and they all have different tax financial situations that you have to kind of navigate through. But these concepts are available to almost anybody. And don't let anybody tell you that we can't take advantage of tax benefits. There are tax benefits that everybody can take advantage of. Some more, some less, but everybody can take advantage of them. So we provide the concepts. The landowners run the numbers. That's the phrase that we use. You must run your own numbers because, again, the set of circumstances is different for each person. If people think about what we have to sell, we sell conservation. People love their land. We try to rely on that as much as we can, but we also can sell tax benefits, and that's something that's very powerful in this field. And particularly as you go down, you can see how you can mix and match them together to maximize these advantages. So while sometimes the tax benefits can't make people whole from the amount of money they can get on the open market at a fair market value sale, it can reduce the pain of donating land or selling land cheaply that they want to see preserved. And so let's go to the next. We'll start off with we'll start off with the joke next. So these are the types of property of taxes that we want to expose you to and see how they relate to a given situation. So I'll first talk about the property tax situation next. So we all know and understand, I think, that if you no longer own property, you no longer pay taxes on it. And we have a very important um, Supreme Judicial Court case from 2014. It was the New England Forestry Foundation versus the town of Hawley that did certify that land owned by nonprofit land trusts is generally tax exempt. Um, and so the important date to remember is July 1st. So you can acquire land up to any time before July 1st, even June 30th. And by law, by operation of law, it becomes tax exempt the following day. You do have to apply to the assessors for property tax exemption, the Form 1B3, but that's the operative date. Don't let them tell you that it's January 1st or the following January 1st. It's July 1st, and that's right in the statute. So that's the best way to reduce property taxes, to no longer own it. Give it or sell it to the land trust or to the town or to the state, and they know landowners no longer pay property taxes. With conservation restrictions, the situation is different and it's highly variable throughout the state. Each town assessors have different practices and policies. Here on Cape Cod, the assessors have been very generous in giving as much as 95% reduction in property tax for perpetual conservation restrictions. But in every town on the Cape, every town in the state, the assessors are obligated to consider what impact does the conservation restriction have on the development rights for the property. And usually that should dampen the property tax. There are certain situations where it might not, and the assessors might argue that. But in general, the conservation restriction will reduce the property tax going forward in the next fiscal year again. So, reserve life estate, you should be familiar with this concept where title passes during the lifetime of a landowner. They continue to live on the property. They have exclusive use and occupancy of the property. But because the use is still residential and not conservation yet, it's conservation when they die. Um, the assessors are not obligated to give any type of property tax relief. So, you want to keep that in mind. And then the current use assessment programs, the so-called Chapter 61, 61A and B, that does give an annual reduction in property tax based on a set of formulas. Um, I don't know about you, but I don't consider this a conservation program because I consider it more of a tax dodge or letting people off the hook until they decide to develop their property. But it does buy some relief for people that have not yet made that decision. Um, I'm happy to take people to argue with me, but that's the way I feel about it where I live. Next, next. We have to use these pictures to break up this very tense stuff. Okay, Rob, take it away. You're muted.
Unmute yourself, Rob, please.
How long have we been doing Zoom? Thank you. I'm just going to start off by reiterating Mark's caveat that we are not tax advisors, cannot give tax advice. We really just want to introduce you to all these concepts so you can introduce landowners to these concepts so they can go talk to their lawyers and accountants. 'Cause as Mark said, no one else is going to make them aware of these in all likelihood. So turning to how income tax benefits intersect with land conservation. First, a couple of definitions. We'll talk about gifts, and quite simply, a gift in this context means either the outright transfer at no cost of land to the land trust. Same with a gift of a conservation restriction. It can also include selling land or a conservation restriction at less than its full value, something Mark is going to talk about later on. But all of those contexts in this income tax universe, we just talk about as the gift. We're also going to talk about AGI, adjusted gross income, which is a number that will show up on your tax form. It includes all of your income, whether that's wages, your trust fund, your bar tips, wherever it comes from. If it's income, it goes into your adjusted gross income. For clarity, that then gets picked apart before taxes get applied, but that gross sum of income is a critical number in this process. And if you've all done your 1040s, it's at the bottom of the first page. And then fair market value, something I think we are all very familiar with, simply the professionally estimated value of the gift. So in the world of income tax benefit, what we're really talking about is a deduction, which is a reduction in the income on which you are taxed. So very different from a tax credit, which Mark will be talking about in a little bit. So this context, the deduction comes off of your adjusted gross income before the tax is calculated. There are many rules throughout all of this process. So we're going to hit on key ones, but there are always footnotes. Gifts of fee ownership of land are limited in terms of how much of a deduction you can take in any one year. That is limited to 30% of your adjusted gross income for that year. However, any portion of your gift that you can't deduct in that first year, you can carry forward into future tax years for a total of 6 tax years. So that's a good way to come at pre-estimating what kind of benefit there might be to a given landowner. They're going to know their adjusted gross income. By and large, they won't be sharing that number with you, though some folks do. The rules are different. If someone wants to make a gift of a conservation restriction, you can in each year deduct up to 50% of your adjusted gross income, and you can spread that over a total of 16 years. And this basically, in a nutshell, reflects a preference from many in Congress that land remain privately owned, and they prefer that many powers would prefer to see a conservation restriction on privately owned land rather than see the ownership transferred into government or nonprofit. So that's a very abbreviated history of why those sets are.
Rob, before you move on, I just want to interject. Some landowners that I've talked to think that these percentages are percentages of the value of the gift as opposed to value of their adjusted gross income. So you want to make sure that that's clear to people. It's not, the value of the land might be $1 million. It's not 30% of $1 million each year. It's 30% of your income. You eat into that $1 million deduction each year, but you can only use 30% of your adjusted gross income each year.
Exactly. So moving from the deduction, the amount by which the gross income is reduced, over to the actual tax savings is it's a different number, it's a different category. That tax savings, the actual money that kind of stays in your landowner's pocket rather than being paid as tax, essentially is an interaction between the deduction, the gift, and the tax rate of the landowner. So in our tax system, we have a so-called progressive tax system. Depending on your income, your tax or marginal tax rate can be anything from 10% up to 37%. Now, those percentages don't apply to your entire income. So, you, me, and the 1% all pay, I believe it's 10% tax on the first $11,000 we earn. We all then pay 12% on the next roughly 35,000, and we all pay 22% on the next 50,000. So you're only paying that higher rate on the top layer of your income, and we're all paying the same at each layer. It's just that many of us have more layers, and so the number keeps going up. So what that means, if you look at the calculations there, a gift of a value of $100,000 for someone in the 22% tax bracket, they actually have tax savings if their adjusted gross income, et cetera, works out over 6 years, of 22,000, whereas that same gift of a higher income individual will give them actually more tax savings in that example, 32,000. So it does skew the benefits to higher income folks, but as Mark said, there is something here for virtually all taxpayers.
Well, what about taxpayers, Rob, who really don't pay any federal income tax? Can they still take advantage of any of these things?
If they're not paying income tax, then there is no income to offset.
Right.
So from
Okay.
the deduction perspective.
So in my case, what I would recommend to those landowners is transfer the land, the title, into somebody in the family that can take advantage of it. Whether it's a kid or a sibling, maybe you ask them to buy the land from you so that they can take advantage of these gifts, deductions. So there's always some way to make it work.
And that's a perfect lead into the next point, which if you do transfer it to a family member or, dear friend, um, that person would have to hold the land for a full year for it to become a so-called long-term asset, and for all of the rules that we're talking about to apply. So you can make gifts of short-term assets, but all of the percentages and the rates and the numbers are different in that case, as is your ability to use any appreciation of value, which we'll talk about in a sec. So again, all of this is talking about long-term gifts of long-term assets, and many of the rate numbers I'm using tend to be for tax rates for single persons, though married filing jointly is often what we're dealing with, and the numbers are a little different, but the principles are all the same. This should be familiar to everyone. If a landowner wants to claim a deduction for a gift of land, the IRS requires an appraisal for anyone claiming a gift above 5,000. So that's generally going to include all land gifts. The IRS has its own rather elaborate set of rules and specifications for how that appraisal is carried out. So you don't really just want to go to your neighborhood real estate appraiser who's doing houses around town. You want someone who has prepared IRS appraisals before, and they have to prepare that for the landowner. That needs to be prepared for and addressed to the client as the landowner. In that process, the land trust will be asked to sign a form 8283, which certifies that the land trust received the gift of land, but it does not certify the value of that gift. So, that said, there is, in many people's view, some reputational risk of signing off on an 8283 that has a preposterous value of the gift. It is not your job to make sure it's precise. It is not your job, to call foul, but it is wise to request a copy of the appraisal, to read it, and if your head explodes, then start raising questions. And if it seems, something that is within the realm of potential reality, then you're probably in the safe zone. And it's really the landowner and the appraiser who are taking on significant liability if they're pushing the limits beyond reason.
Yeah, I think the only time I've ever questioned one, and I would always sign it if I see the number. I'm not going to substitute my judgment for that of the appraiser. But what I might do is send a note to the landowner and say, you might want to have that appraisal checked again somehow.
Yeah.
In other words, sending a signal that it could raise eyebrows.
I have definitely pushed back on a handful of appraisals. It's a very uncomfortable process. The landowner doesn't want you to do it. The appraiser is annoyed. But if you really believe you're on solid ground and raising questions, then it's a conversation worth having. They need your signature. You've already developed, hopefully, quite a relationship with the landowner, and there is a partnership between the landowner and the land trust. Fair market value. I think this is fairly straightforward. The fair market value, generally as established by an appraisal, perhaps quite obviously, but worth noting for the moment, includes any appreciation in value. So somebody who bought a chunk of land for $1,000 years back, and now it's worth 100,000. When establishing fair market value, the price they paid is not relevant. When establishing some tax implications, it does become relevant. But the fair market value includes any appreciation in market value over time since the acquisition. Here in Massachusetts, we actually have a version of this. 25 years ago, we had a Massachusetts charitable deduction for, I think, about 1 year. I gave away a jalopy that year. And it has now returned in 2023. So it is independent of any federal tax deduction, that might be sought. However, in Massachusetts, the deduction can only be deducted from wage income. So a high net worth person who is living off only investment income might have some difficulty accessing this deduction. But a working landowner or a person who is who actually has wage income wage earnings can take advantage of this. And again, it's an intersection of the value of the gift and the tax rate. We're at a 5% blanket tax rate. So that is the savings, the tax savings relative to the deduction that would be applied. And I'll note here, Mark's going to talk about the state land tax credit in a bit, but you cannot do both in Massachusetts. You can't, if you're in the state credit program, then you cannot do the income tax deduction, and you will do better in the state tax credit program. So it's never a reason not to do that. I don't want to, yeah, we're going to keep moving along, but I wanted to just touch on various ways that deals can be structured to help a landowner in their tax situation. So actually, let's start on case 2 here on the right. You know, if a landowner is trying to maintain their status in a lower tax bracket to spread out their income from the gift, they could divide their land either as it's already divided or work with a survey to divide it. And every year or a couple of years, gift a portion of that property. And over time, it all comes to the land trust. One would hope that they also put something in their will for the remaining land if should they die before the last component is transferred. Case 1 on the left is where a landowner can take on the entire property, can give you an undivided partial ownership interest in the land each year or year by year.
Yeah, he had surgery yesterday. Good for you for remembering.
See if we can.
And
Thank you. So that so-called undivided interest in land can be is tax deductible. It's recognized as tax deductible. Because the land is still partially privately owned, it remains subject to property tax until all of it is in the hands of the land trust, but you're saving on survey costs that other scenario might trigger. So there's some back and forth to be figured out if payments over time are a vital approach in the negotiation. A third way is to do the land deal at the front end and simply make payments over time. And that can be done under contract. This is one that has always seemed really attractive to me, and yet I'm not sure I've ever executed a deal that included this in the final version. But it's been helpful in discussions, even if not used at the end of the process. It's a great way to kind of demonstrate flexibility and collaboration with your landowner. Mark, should we stop for a couple of questions rather than trying to push it all to the end?
Oh, clear as mud, I'm sure.
Yeah. Barbara, are you able to watch the chat?
I am. I don't see any people in there other than
Okay.
Rob says we're going to be sharing the link to this PDF afterwards. But if anybody has a question, put it in the chat, please. Oh, we have a hand from Meredith. Meredith,
Wait.
unmute.
Sorry if this was covered. I missed just the first couple of minutes, but with the charitable deduction and the appraisal you all were talking about, Rob mentioned the landowner seeking the deduction, of course, needs to contract that appraisal and be the client on the appraisal. And something we've kicked around is the question of whether we as another entity could fund that appraisal, even if the landowner actually contracts it. And you're all saying yes, it looks like so. Okay.
Yeah, it used to be, Meredith, the rule of thumb that I came up learning was that the land trust could have no role in the landowner's appraisal. And that was, in a lot of the instruction manuals that I learned early on. But I did attend a workshop with the IRS agent at the Land Trust Rally about 5 or 10 years ago, and she was asked that question, and she didn't seem troubled by who pays for it, as long as the client is the landowner. So I don't know if Rob has any different experience.
No, that's straight from the horse's mouth, which is great. Not you, the horse, but the IRS. The other thing I would add is that, often by the time the landowner is looking for an appraisal, the land trust has already done one for its own purposes. And I have many times given a letter to the appraiser releasing them to use their file information to create a separate and slightly different IRS specification report for the landowner, so they don't have to go find a different landowner. You start with someone who's familiar with the property in the scenario. There's not necessarily a ton of savings to the landowner in that. They are probably going to get charged for a full appraisal anyway, but it could be a little more expeditious, and it will be a appraiser that you have faith in, having used them yourself already.
Talking about appraisers, there's another question from Anne. Federal appraisals must be Yellow Book?
It's different. No, it is not Yellow Book. Yellow Book is the appraisal standards for federal acquisition of land. So if you're working with the Park Service to acquire something, they're going to need a Yellow Book appraisal. The IRS has its own unique set, and some of it is formulaic, but some of it can result in a slightly different analysis that can result in a slightly different value. So I've never seen them miles apart, but the number is not always exactly the same, given, an appraisal is a structured process of estimating. And if the structure is changed, then the estimation outcome is likely to get tweaked a little bit. But it's different from Yellow Book.
Following on that, Rob, then I'm assuming the IRS requirements are not as onerous as the Yellow Book standards, and therefore there might be more appraisers qualified to do them.
Yes.
Yes. Yeah, Yellow Book actually requires you to be certified, the appraiser to be certified by the feds. They've got to go through a training and get signed off. Not so for an IRS appraisal.
You just have to be a qualified appraiser. And they decide whether they're qualified or not. There are credentials for the industry having to do with education, but and appraisers have licenses, but they're not necessarily they're not certified as in terms of federal Yellow Book standards. Most of them, I think we only have 2 on the Cape that are certified for Yellow Book. Yellow Book is also required, Rob, for any type of federal grant funding to a project, right? Yeah.
If
I
there are no other
apologize.
questions
Oh,
right now, should
okay.
we move along? Or
Great.
There's one that's simply clarifying on what we've covered. We could maybe do one more, and then, this 1-hour session is a challenge.
I just was going to apologize for the Cape Cod centric photos that you're going to be watching here. So I know the state is bigger.
Mark, I'm bringing my own pictures.
I know the state is bigger than Cape Cod, but go ahead. Let's move
All
on.
right. Okay, so moving from property tax to income tax to capital gains tax. So now a third category of potential tax benefits. Capital gains tax is really simply put the tax that you owe the government if you acquire an asset at one value and you sell it at a higher value. That differential is considered your gain on the property. If you buy real estate and you own it for 30 years, the value probably is going up most years. You don't owe any tax on that value until you so-called realize that gain. You convert that increased value of your asset into cash. And at that moment, it becomes a capital gain, and gain is subject to tax. Your tax is calculated only on that differential, the gain, the profit that you've made on this transaction. So you can deduct out what you paid for it, further investments you've made in it. There are a lot of rules about how that's set up. But that differential is then subject to capital gains tax. Again, we're talking here about long-term assets, long-term capital gain property held for more than 1 year. And here again, we get into questions of different structures of deals. So donated land outright from landowner to land trust avoids all capital gains tax. So this is really kind of a major selling point when you're talking to a landowner versus them selling it on the open market. So this is, these are big assets. Many times we're dealing with families that have owned the land or inherited the land, and it's gone, it hasn't, their basis, their investment in the land is rather low relative to its value today. So that avoided gains tax can be quite significant, and this is one that is well worth including in your conversations. So even though the landowner, let's say they buy it here, they sell it here, or it has this value when they donate it, they do not pay any tax on that gain. they still get that total value to their deduction against their income tax. So it's really a twofer here where they don't have to pay for the gain, but they get the benefit of the gain from the donation standpoint. Bargain sales don't avoid all of the gains tax, but they do reduce it. And it's actually a fairly complicated little process to figure out what that is. The basis gets apportioned between the paid for portion and the gifted portion, so there is some math to do there, but it's there's still a benefit. The rates are all separate from the income tax rates. On the federal, you can see it there. You know, if your income is under 47,000, you don't pay on a gain. But if you're in the 47,000 to 518,000 range, which is where a lot of the folks we work with exist, they're looking at a 15% capital gains tax. And if they're over that number, it jumps to 20% all the way on up. Similarly, at the state level, we're at a 5% capital gains tax for the category that fits land, and one of the higher rates in the U.S. But there is an exemption if the landowner is selling their primary home as part of this deal. There's a partial exemption from the total gain.
That 250,000 again is for a single person.
Yes, thank you.
Mhm.
It's, I think, double that for married,
Right.
filing joint. Okay, Mark.
All right. Well, so something new under the sun. About 12 years ago, the legislature passed instituted a new program called the Conservation Land Tax Credit. And of course, we've given it the acronym of CLTC. Part of your jargon as a land conservation person, CLTC, Conservation Land Tax Credit. And so a tax credit is different than a tax deduction. It's much more powerful in the sense that it's a one-to-one benefit as opposed to a percentage, as a deduction would be. So the state rule is that if you have land that is considered by the state as conservation worthy, and you apply to this CLTC program, and Tom Anderson, who runs that program and has since the beginning, will be reviewing the land to see if it meets natural resource protection values, whether it's habitat, water protection, linkage, recreation. And if it does meet those tests, any one or more, then he will declare the land eligible and tell you to keep moving through the process. And so the next step in the process is to have the landowner obtain an appraisal of what they're donating or selling cheaply, whether it's the title or conservation restriction. And then once that appraisal is done and sent into the state for review, and Tom writes back and says, yes, it's acceptable, he'll give you a slot when you can close the transaction. It works on the calendar year basis, not the fiscal year basis. So right now, there's still a little bit of money left for calendar 2026. If you apply today and get an appraisal approved, there might be a slot for you in calendar 2026 to do the deal. Otherwise, you'd be in the waiting list for 26 and be pushed out into 2027. But the program has a limited amount of funding. It's only $2 million a year. We've been trying as a land trust community to get that bumped up to $5 million. Have had no success. I think it's typically in the is it the Senate, Rob Johnson, that is the problem. We can't seem to get over the hump, but with more support, maybe we can. But right now, that $2 million pool that's available each year is limiting the number of projects that can be completed each year. And so right now there is a cap of $75,000 as the maximum amount that the state credit can be secured by the landowner, or 1/2 of the appraised value of the land or the value that's being donated, whichever is less. So to me, the sweet spot is to get a bargain sale with $150,000 price break, because that will generate the maximum $75,000 as a tax credit. So they're not really giving away $150,000 worth of value, because they're going to recoup 75,000 of it back in the form of this tax credit. This is not a it's a 1 year deduction, 1 year credit period. So the year of the transaction is the year in which you would claim the credit. It does not carry forward. And so it's been very powerful. We've done about 150 of these on Cape Cod now in the last dozen years. And you don't have to live in Massachusetts. I've gotten tax credits for people who live in Canada, and they do have to file a state tax return in order to claim the credit, but they will get a check. Next. And it comes looking like this. And people don't believe it, but it happens. And so far, everybody that I've completed a project with has gotten a check. Sometimes not all the 75,000 because perhaps their land isn't worth as much. But it's been 1/2 of the value if it's not the 75,000. So next. And it's had great impact throughout the state. I would say 2/3 of towns have had at least one project at this point. Those numbers are out of date now. Next. So, the tax law giveth and the tax law taketh away. In 2019, when the last time the tax reform were made in Congress, they decided to disallow unlimited deductions for state and local tax credits deductions. So there's a cap, and this is basically a way to have the IRS recognize the fact that you've received up to $75,000 as a state tax credit, and they're not going to give you that portion of your deduction on the federal income tax deduction side. So you have to subtract it from your appraised value of your federal deduction. There are levels of this. We don't have time to get into it today. I'm happy to send you the way it matches different income categories. But the idea is to limit the federal deduction by the amount of the state tax credit. So I'd still rather have $75,000 in a check than $75,000 in a tax deduction. And I think you would too. Next. Next. So bargain sale is really just a mix and match of cash and tax benefits in any particular transaction. So it's because you've negotiated a deal that's less than the appraised fair market value with the landowner, because the landowner wants you to succeed. He or she wants to have that land preserved and is willing to take a haircut on price to make it work for you so you can raise the money or get the grants necessary. And they're willing to take that reduction in cash in the form of some of these different powerful tax credits and tax deductions. So at the end of this, we're going to do a little exercise to show you how you can change these variables around and find that sweet spot. That's a reduction that lets you reach to buy the land, but has a little bit of pain for the landowner because they want to see the land preserved. Next. So again, you're not going to study this. We're going to get into it later, but I want you to just see the two different columns. The first column is conservation, and the net at the bottom is $274,000. And the net for development on the right is $305,000. So you say, well, why wouldn't I want to sell it for development? I'll make more money. Yeah, but you've given $150,000 haircut on the price, but you've really only lost $30,000 because of these powerful tax equations that we'll get into. So that's the point that we want to make here. Next. So a specific example. So we have a landowner who suggested gross income is low. They still have some income. They do pay federal and state income tax, but they want to donate land that's very valuable. It's been appreciating in the family for decades. How are they going to do this? And so the way to do it is to do two transactions. You want to take the conservation restriction deduction first to accelerate and extend the federal deduction. Remember, we said that instead of a 30% reduction in adjusted gross income each year for 6 years, the conservation restriction allows you to reduce your adjusted gross income by 50% for up to 16 years. So even with a low adjusted gross income, maybe you can take $1 million deduction if you spread it out over 16 years. And so then you use up that deduction. And then if you still want to see the land preserved, you donate the title. And the restricted title is obviously not worth as much. It's the difference between the value when it was developable and the value with the conservation restriction on it. But it's a second deduction. And so now you've got a way to get another 6 years. So maybe you've got 16 years plus 6 years. You've got 22 years to deduct it. I expressed this to one of my elderly couple landowners, and they said, 16 years, we're 86. So they in that case, they just wanted to donate the land and not be getting too exotic with these different mix and matches. But let's go to the next slide.
Mark, just to clarify on this, your story talked about doing these transactions separated by 16 years. In fact, you could overlap these transactions as long as you do the CR first and then do the restricted fee gift subsequent to that, correct?
Well, I don't know, because remember, you're limited to the amount
Numbers, yeah.
of adjusted gross income each year.
But again, it's a run the numbers question.
Yeah.
From a rules standpoint, you could overlap them, but from a best advantage, you got to figure it out.
So why can't, if I give the land to, or give the CR to a land trust A, why can't I give the title to land trust A at the end of my deduction period? Well, the reason is that the conservation restriction would merge into the title, and that's a no-no under our state rules for conservation restrictions. And so we want to find another land trust or the town or a state agency that would take the CR, get assigned the CR to that second land trust, and then donate the title to the first land trust. Next. Yeah, that's what we were just talking about. We should have been on that slide, I guess. Oh, one other thing to realize is that it doesn't apply too much in Massachusetts, unfortunately, but if you are a qualified farmer, and I think the qualification is you get at least 40% of your income from farming, you may be doing things on the side like landscaping or whatever, working in a high rise, but if you get 40% of your income, that qualifies you as a farmer, and you can deduct all of the conservation restriction, all of your adjusted gross income to use up that that value over the 16-year period. So the thing to remember, the principle is that this powerful new conservation restriction deduction rules accelerate by being able to tap into the deduction value in a greater extent each year, and you can extend it from the 6-year period to the 16-year period. So accelerating and extending, that's the key to this. Next. So we're just a little example, 5 acres on a pond. It could be 4 lots. It's a long-term held property, so capital gains would be part of this. It's appraised as a potential subdivision at 550,000. The conservation restriction, which is the value of the development rights, is most of that value. In this case, in our example, $430,000. And the gross income is $55,000 for the landowner. And we're assuming that that number stays constant over time. Of course, it doesn't. People's adjusted gross income go up and down every year. Next. So here's a concerned landowner that she's going to leave a lot of money on the table. She's got a value of $550,000. If she gives it away right now, she's only going to be able to use about $99,000, less than a fifth of that value of the gift. And so she's not very happy. And so the tax advisor says, well, let's ask the fancy pants land trust that knows all these other ways to do things. Because that tax advisor doesn't even know about conservation restrictions, perhaps. So next. So again, they went to the land trust. The land trust says, well, you can break this out and you can do a conservation restriction first and get that better tax treatment, accelerate and extend the deduction. And then you can donate the title later and you get a second deduction for that. And you've used up $529,000 of the value of the gift of 550 instead of the 99,000 in the fee simple, direct fee simple way. So has this ever been done? In fact, we're doing it right now in Barnstable with a family, a mother and children, and they limited incomes. This seemed very attractive to them, and they are pursuing it right now. So I hope it all works out for them. It's a great little property with some vernal pools on it. Next. Again, not Massachusetts, Cape Cod.
All right, so turning to yet another tax category, we're going to talk fairly quickly about estate tax implications. And we do want to have some questions at the end. So if folks have burning questions, please put those into the chat. And then we'll try and address those before we wrap up. So the estate tax, there is a federal estate tax and there is a state estate tax. They're quite different in how they operate and how they affect our transactions. The federal estate tax is just not an issue for most people. The first $13.99 million of your estate is exempt from federal estate tax. So that addresses most of the folks that we will ever meet, let alone do deals with. So it is, however, an important element nationally, as noted there on that first bullet. A tiny percent of taxpayers pay the estate tax, and yet in 2022 it generated $34 billion of revenue, which even at the federal government level I think is real money. So the exemption, at the federal level takes most people out of concern about this. There are situations, particularly in areas where, ranch lands may be immense and immensely valuable, and where the land, the value of the land in an estate can actually be a problem for the family. So there are ways to get land assets out of an estate. Certainly all the things we've been talking about beforehand. If you don't own it anymore, it's not part of your estate. But there is also now a provision, has been for some time, that a conservation restriction can be placed on the land after the death of the owner. They can put it in their will that they want that to happen, or their executive, or these days personal representative, can choose to make that happen. The heirs are probably in that conversation, but there is specific tax provision for this. And you actually get a bump. So you get to remove from your estate not only the value of the land of the conservation restriction, but you actually get a bonus on top of that within certain limits. So again, only is really going to apply to folks of extremely high net worth. But if you're in that category, there is some great work that can be done here. The state is actually very different. Here, the exemption is only the first million for individual. And, with property values as they are in Massachusetts, quite a number of people will have an estate that exceeds $1 million in value. So working through, considering the impact of removing an asset from their estate, even though they're not dead yet, is a useful talking point to get people to consider additional value to their heirs of getting conservation done now through a donation or partial donation scenario. I'll note quickly, some of you may have dealt with this in the past. The Massachusetts estate tax used to be this weird thing where you were actually, if your estate was just under $1 million, you paid no estate tax. If it was $1,001,001, you paid estate tax on the entire $1,001,001. That structure is gone. It's a simple $1 million exclusion from your estate calculation.
Okay, well, so now you know everything there is to know about tax benefits for land conservation. But again, the principles are key here. So real estate sometimes goes down. I mean, Rob and I have been doing this for long enough. We've seen a few recessions where land prices did go down, but they always seem to go back up again. And
And losses are also deductible.
yeah, good. Um, and certainly during the run up in COVID, I think it was as much as 30% run up during the COVID years here on the Cape. I don't know about elsewhere. Um, so, to me, uh, the the higher the land values are, the better for me. If I'm getting people to donate land or to get a big bargain sale going, I want them to get all the tax benefits they can because it's an incentive, it's an inducement to them to want to work with us for conservation. So I'm there cheerleading, go get a nice big appraisal and not, a fraudulent appraisal, but make sure that they're getting every bit of tax benefit they're entitled to. And so that appraisal is the most important thing. It's not what the town assessed value is. It's not what the realtor in the corner store thinks it's worth. It's not what the land trust thinks it's worth. It's what the appraiser who's working for the landowner says it's worth. And appraisals can vary widely. The same two qualified appraisers could look at the same property, come up with a different set of assumptions and different comparable sales, different adjustments that they make. But it is that appraisal that the landowner obtains that controls all of these variables. So again, you want to make sure that you're not giving tax information, tax advice, legal advice to any landowner, but you want to say, these are the concepts that you should test with your advisors. And we can show them a little sample spreadsheet, which we're going to do in a minute. But they might say to the landowner, well, that's all well and good for the land trust, but they don't know what your situation is. And I agree. But if you don't give people some idea of what these benefits are and how powerful they can be, and you just throw them onto the resources of their tax advisor, they'll often be talked out of a deal. That's my experience. And I apologize to all the attorneys who are on the show here, but law offices are where conservation deals go to die. And so you have to find a way to keep the landowner interested and push back against the attorney who says, no, 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 you should just go get as much money as you can. I don't want to get the most money. I want to see the land preserved. Well, you're leaving too much money on the table. Well, the land trust has a way around that. So those are the conversations that this stuff is supposed to provide. It's not going to cure every situation, but it's going to keep the conversations going. Okay, so I think we've beaten that to death. Can we move on to the next?
Yeah, I'm actually looking in the chat.
Okay, well, let's do that now. Yeah.
Not sure what happens if I stop sharing, but anyway. So I'll respond to Stephen O'Grady's question on capital gains. In the case of a bargain sale, if basis of a property is 500,000, fair market value is $1 million, and the landowner sells it for 500,000, they still owe some capital gains tax? Yes. So let's use proportions. So if if your basis, your investment in the property is half of what you sell it for, or half of what it's worth, and you sell it for half, you actually only get, out of the 500,000 you receive, you only get to take half of your basis out of that, because the other half of your basis is attached to the idea of the partial land that you got paid for. So yes, they don't all go down at the same rate. The basis has to, and various other things have to be apportioned between the gift part and the paid part of the transaction.
Yeah, the APRs, CRs, the qualified farmer rule is the same. If you have a perpetual restriction that qualifies under Section 170H of the Internal Revenue Code, whether it's an APR or CR, my understanding is that those are treated the same for that accelerating and extending provision. Tax considerations when there's a home on the property. If you're donating a home on 10 acres to a land trust, it's the value of the entire property, including the value of the home, if it hasn't been separated out. And isn't this?
Obviously, there's issues for the land trust. If it's a bargain sale and there's a house, you can access part of the residential exemption that we talked about on capital gains tax.
Yeah.
And Leonard, I believe you're right. I think we just didn't get the PowerPoint updated. The current state exclusion for estate tax is 2 million for the individual.
We all learned something today. Thank you.
Embarrassing.
Can I share my little spreadsheet? We got a few
Sure.
minutes left. Okay, let's see if that works. Can people see it? The screen? Okay. So this is what I was referencing earlier. And this is something that's it's just a simple Excel spreadsheet. Each of these cells has a different variable, and you can go through and actually change these with your own values and see how it rattles through. So just to go through it, we want to know the variables up front. So what's the appraised value? 400,000. What was it worth when the landowner originally had it? In this case, it had a stepped up basis, maybe when somebody died, and so it was 100,000. You want to know the tax bracket of the seller or the landowner. And if there's a broker fee involved, those have all changed in the last year. So, but this is how we used to use a 5 or 6% broker's fee. So this is for development over here. Development sale. So we go to the landowner, we say it's worth 400,000 and you can sell it on the open market. Maybe you can get that. But if you want to see it preserved, we think that $150,000 charitable gift in the form of a price break to us will enable us to find the $250,000 that we need to come up with. And then you can have the $150,000 in tax breaks. And so we'll show you how that rattles through. So this is a bargain sale. They're receiving some cash, 250,000, and some tax benefits based on an appraised value of the gift of 150,000. There are broker's fees in both of these situations. Sometimes if it hasn't gone to the real estate market yet, the broker's fee might be zero. Let's pretend that that's what's happened here. But there's still capital gains. You'll see it's less on the sale for conservation because the price that's being paid, $250,000, is less. And there's actually a worksheet over here that shows you those proportions. And again, those numbers carry through from the other page, but then they come back over. I don't have time to get into the ratios, but that's what Rob was talking about as a proportionate capital gains calculation. So we have it a $150,000 charitable gift. We've got somebody in the 22% tax bracket. They're going to get a federal income tax savings for up to 6 years. They're also going to get, in this case, this very powerful state tax credit. And they do have to pay federal tax on that $75,000 the following year. So you go all through this, the net is 287,000. The sale for development, there's no charitable gift, so there's full capital gains to pay. You do get to subtract the broker's fee from the capital gains. But you can see that they're paying more capital gains tax, state and federal, and they have no offsets. So the 305,000 is still, 20 something thousand more than they get for the sale for conservation, but they made the land trust able to make this deal, and they got not 250,000 in the final analysis, they got 287,000. So that's the power of these tax deductions. So when you mix and match them, figure out what works for people. This little yellow thing here is talking about that IRS rule. You have to subtract the tax credit from the charitable gift. That's why there's less in federal savings than there used to be. But I'm going to make this available to anybody who wants to use it and play around with it, and do a project that you're working on now and see if it works. And show it to a landowner. And if they say, "Oh, you're crazy," I'm going to show it to my accountant. Go ahead, show it to them. It's, I mean, it's just numbers, it's just concepts. And he says, "Well, you're not in the 22% bracket, you're in the 24% bracket." Okay. We'll change it around, and it'll come down and through. Anyway, this is the point to do this for people. And do it for yourself first, and play around with the numbers to see where the sweet spot is. But I think that it's a very powerful tool. I've used it many times, and I hope that other people will too. So that's all I have to say.
I think we need to leave it there, sadly. There's a hasty trot through the garden of delights of tax benefits, but hopefully it's been a good introduction for folks. There are a lot of other resources, places you could follow up on these. And I know Barbara will be posting the presentation. I think also the spreadsheet, right? Mark?
Yeah, and I'm going to put my email in if anybody wants to follow up with me afterwards. So that's that.
Great.
And I really appreciate everybody's attention for a very dense subject.
Thank you
Thank
guys
all
for
being here.
making it quite clear. It was relatively easy to follow, so that was great. And yeah, thank you for offering to share the spreadsheet as well as the PDF of the slides. So we'll make sure people get that.